depreciation is one of the best benefits to owning real estate. Kind of break down what depreciation is if you're a real estate owner.
Sure. So you buy real estate, residential or commercial. It's essentially wear and tear on a building. So if I bought a building from you, Tom, or you, Mark, today, the government would say this building has to go on a depreciation schedule. So all buildings by law have to be on a depreciation schedule. What that is just a way to break out land costs from the building cost. And the federal government says a commercial building has to depreciate the structure over 39 years, and a commercial building has to depreciate over 27 and a half. But it's wear and tear on a building. So what it is I buy a building from you guys. The day I buy it, the brick is deteriorating, not at an accelerated rate or anything, but it is day by day. The roof is getting weaker and weaker, little by little, right? So that's why they give you such a long life for a building asset. The HVAC system is closer and closer to failing. So what they do is the government knows this. They know you need a break. They incentivize you to own property, and they give you a reward in the form of depreciation, which is just a fancy term for write-offs.
Now, that when it's depreciated, if they're saying the estimated lifespan, just for conversation's sake, is that 39 and a half years, each year when you're filing taxes, are you taking the value of your building or your property minus your land and dividing that by 39 and a half, and that's what you get? That's your write-off you're getting on your annual tax return?
Yeah, so straight line depreciation, we can do a quick one, and this is an example I always use. You buy a commercial building for $1 million. Okay, so I buy it from you guys. The federal government's going to say 𝗏𝗏𝗃𝗀𝗃𝗃 needs a depreciation. So if it's a 39-year asset, how do they come to what my write-off is? All they do is they take your purchase price, just like you said, Mark, minus land value, divided by 39 or 27 and a half. Okay, so a quick way to explain it. I buy a building for 1.2 from you, Mark. It's a commercial building. We'll say it's a small hotel. We're going to put 200 grand towards land value. So now you got $1 million divided by 39. And that equals 25,600. So from year 1 to year 39, or up until I sell it, I'll get a standardized write-off of 25,600 every year. Standardized. And that's straight line depreciation.
And you back out the land because land doesn't deteriorate, doesn't go bad. And so that's just I know that's not common sense, but I just want to point that out there, that's why that gets backed out.
Yeah, that's why it gets backed out. And depending where it is, right? Land in Manhattan is much more valuable than land in, Chicago's West Side. So what we do is usually consult a tax professional and get their opinion. But the most standard land value used in the United States is 20%. Okay.
So I know there's a lot of people out there that probably have not talked to their accountant about splitting that up. So are you saying that standard, most CPAs or accountants are just basically looking at somebody's closing statement, they bought the property this year, and usually just accounting for 20% of that cost being the land? So that's fairly standardized, you're saying?
Yeah, it's fairly standardized, but in my opinion, it shouldn't be. So the less value you could apply to land value, the more goes to the building value, which is better for your basis. So if you get a really savvy real estate CPA, he might do some calculations, say, don't use 20% land, use 15. That's 5% more that gets added to your building costs, which is good for you guys.